Hey everybody, welcome back to the channel. Today I'm going to be going over some practice questions for your life insurance exam. I hope this can help you feel more confident about passing your test. I've helped thousands of people pass their test, and I've helped hundreds of people make $100,000 or more in this industry. It's worth it. You're worth it. So stick to it. I promise there is a treasure trove of success waiting for you once you get your insurance license, but it all comes down to passing this exam. So without further ado, I'm going to get started here on covering some of these practice exam questions. Please drop any questions in the comments section in the video, and I'd be more than happy to answer any of the questions that you have. So first question that we have here, what does the free look period allow a new policyholder to do? Is it A, review the policy with no obligation for a specific number of days? Oh, lost that there. Is it B, cancel the policy and receive a refund on any claims? Is it C, increase the policy amount without medical exams? Or is it D, transfer the policy to another person? The correct answer is A. The free look period allows policyholders to review the policy with no obligation and return it within a certain time frame for a full refund. Next question. Let me zoom in a little bit here. What type of risk classification would an applicant in excellent health who does not smoke and exercises regularly typically receive? Standard, substandard, preferred, or declined? The answer is C. So someone who is in excellent health, doesn't smoke, and takes care of themselves would normally receive a preferred rating. Standard is the average rating, so average health, and substandard is below average health, and declined is they are too much of a risk to the insurance company, they cannot get insurance. Next, which of the following is the primary purpose of the Fair Credit Reporting Act? A, to allow applicants to check the accuracy of their medical reports. B, to authorize insurers to gather information about applicants through credit and consumer reports. C, to set a minimum credit score for life insurance applicants. Or D, to eliminate the use of credit history in underwriting decisions. The correct answer is B, to authorize insurers to gather information about applicants through credit and consumer reports. All right. So the Fair Credit Reporting Act lets insurance companies gather information about applicants through credit and consumer reports in a way that's fair to the consumer. What is a binding receipt known as? Is it a conditional receipt, temporary insurance agreement, an unconditional receipt, or a limited receipt? The correct answer is C. It's an unconditional receipt. So a binding receipt is also known as an unconditional receipt, granting immediate temporary coverage. It's immediately bound. Coverage is bound immediately. Next, which life insurance policy provides coverage for a specified period only, ending without any cash value if the term expires? Well, the answer is in the question. That one would be B, term life insurance, okay? Whole life insurance has cash value. Term life insurance does not have cash value, and adjustable and universal life often have cash value. Okay. Which of the life insurance, I'm going to put the answer right here. Which type of life insurance combines both term and permanent life insurance in one policy and allows for adjustments? This question, there's actually two right answers here. So it could be either universal life or adjustable life. I know that's a little mistake there, but adjustable life and universal life are pretty much the same thing. They combine term insurance and permanent insurance. All right. Variable life, if it's variable whole life, it does not have term. And whole life obviously does not have term. It only has permanent insurance. Under the incontestable clause, how long does an insurer have to dispute the validity of a policy? Is it 6 months, 1 year, 2 years, or 5 years? 2 years. So under the incontestable clause, the insurance company has 2 years to dispute a claim. If someone files a claim within 2 years of taking out the policy, the insurance company can dispute the claim. Okay. Next, what is the primary purpose of a family income policy? Is it to pay out a lump sum death benefit, provide a monthly income to beneficiaries for a specified period following the insured's death? Is it to accumulate cash value for retirement, or cover burial expenses only? The correct answer is B. To provide a monthly income to beneficiaries. A family income policy provides monthly income for a set period following the insured's death. Okay? So, insured dies, a family income policy provides income to the beneficiaries. Next, which non-forfeiture option uses the cash value to keep coverage in force for a limited time? Okay, this is going to be the extended term option. So in an extended term option, I have some videos that cover this, but in the extended term option, the cash value is used to buy a term policy that equals the face amount of the whole life that the cash value is in. So say there's $1,000 in cash value in a $20,000 whole life policy, and you want to exercise the extended term option, that will buy a $20,000 term for however many years the $1,000 of cash value will buy it for. Cash surrender option is when they just get cash. They just take that $1,000. Reduced paid up is when that $1,000 buys a whole life policy. That's a lowered face amount. And then loan option, that's taking a loan against the cash value. All right. So what is the effect of the misstatement of age provision? Is it A, it voids the policy? B, it requires a new application if the age is incorrect? C, is it adjusts the benefit to reflect the correct age? Or is it D, it cancels any existing riders on the policy? The correct answer is C. It adjusts the benefits to reflect the correct age. Next question. A blank rider allows the policyholder to add coverage for their spouse and children under one policy. That would be a dependent rider. This will allow the policyholder to add coverage for a family member under their policy. So to say they have a whole life policy, if a guy has a whole life policy, he can get additional coverage for his wife or kids using dependent riders. They're also called spouse riders or children's insurance riders, stuff like that. It's very all those names are interchangeable. A blank insurance provides a death benefit for a specific period, often aligned with a debt like a mortgage decreasing over time. So that would be decreasing term insurance. So decreasing term insurance has a face amount that decreases over time to match a loan that is going down in value as the person with the loan is paying it off. So decreasing term is used to help cover debts, so that if the policyholder dies, then the beneficiaries or the bank, whoever owns the policy, will be able to get the money to pay the loan. Okay, the blank option allows a policyholder to leave dividends with the insurer to earn interest. Cash surrender is not the answer. That's when they just take all the money. It would be accumulate interest option. So what happens in this case is the dividends are left with the insurance carrier, and they accumulate interest, and that interest is paid to the policyholder. 1 year term is when the dividends purchase a term policy, and then reduced premium is when the dividends go to pay the next premium that's due. Blank life insurance policies are designed to provide permanent coverage and accumulate cash value. Well, universal life is a combination of term and permanent, but it's not technically fully permanent. So that's not the answer. Variable life, it could be universal or whole life, so that's not totally the correct answer. Term does not accumulate cash value. The right answer would be whole life. So whole life policies primarily are designed to provide permanent coverage and accumulate cash value. A blank assignment refers to full policy ownership or transfers full policy ownership to another person. That is absolute assignment. So absolute assignment transfers the policy in full to someone else. Okay, next one. Sarah is diagnosed with a terminal illness and uses her policy's rider to access funds while she's still alive. Which rider did she likely use? Is it the waiver of premium rider, the accelerated benefits rider, the accidental death rider, or the guaranteed insurability rider? This one is the accelerated benefits rider. The waiver of premium rider will pay her premium if she is disabled. The accelerated benefits rider will pay her benefit to her if she's terminally ill. An accidental death rider will double or triple her death benefit if she dies as the result of an accident. And the guaranteed insurability rider allows her to increase her face amount at random time periods, at random time intervals, or specific life events without having to go through underwriting and show evidence of insurability. So the guaranteed insurability rider, one example would be, hey, if she has that rider, she could say, hey, if I have kids, I want to be able to increase my face amount. She has a child, she could increase it, or she can say, every 5 years or 10 years, I want to increase my face amount without having to go through underwriting again and show insurability. All right, Mike decides he wants life insurance dividends to reduce his premium payments each year. Which dividend option should he choose? Cash option, paid up additions, reduced premiums option, or accumulate interest? This would be the reduced premiums option. Cash option is when he just takes it in cash. Paid up additions is when the dividends increase his, it actually purchases additional whole life insurance for his policy. Reduced premiums is what lowers his premium. And accumulate interest is when those dividends are just held to accumulate interest. John takes out a mortgage and buys a policy to match the length and amount of the loan, with the death benefit decreasing over time. Which policy best fits his needs? We just covered this. That would be a decreasing term insurance policy. Lisa's life insurance policy allows her to increase her coverage without proof of insurability every few years or after major life events. Which rider does her policy include? We just covered that as well. That is the guaranteed insurability rider. Okay, cost of living rider will allow her policy face amount to increase at intervals to adjust for cost of living. So if it goes up a certain percent a year to match inflation, and then we covered the other riders. If you'd like a study guide to help you pass this exam on your first try, just click the link in the description of the video. And a bunch of these questions and stuff are going to be available in the materials that are in this study guide as well. Emily's life insurance policy has a clause stating that if she commits suicide within 2 years of issuance, the insurer will not pay the death benefit. What is this clause called? That is the suicide clause. So an exclusion is suicide. So if she commits suicide within 2 years of getting the policy, the benefit will not pay out. That's pretty standard on most life insurance policies. Next, which of the following dividend options allows a policyholder to buy additional one-year term insurance? That is the one-year term option. Okay. In life insurance, what is the purpose of the grace period? In life insurance, what is the purpose of the grace period? It is to give additional time for premium payments without lapsing the policy. Okay? So I'm going to go back here. So for the one-year term option, what this does, it uses dividends to buy a term policy for 1 year, and that adds to the face amount of the policy. Next one here, the grace period, it says okay, if your payment is due on the third of each month, but there's a 30-day grace period, you have 30 days from the 30 of each month to make the payment without your policy lapsing. So it gives them extra time. What is the primary benefit of variable life insurance or a variable life insurance policy? Guaranteed minimum death benefit with cash value tied to investment performance. That answer is A. So variable life offers investment potential in separate accounts affecting the cash value and the death benefit. So that's this one. A flexible death benefit is universal life. Guaranteed fixed premium with level death benefit, that is whole life. And then minimum investment risk and stable premiums will be whole life. Variable life is tied to investments like stocks and bonds. Okay. A whole life limited pay policy allows the policyholder to make premium payments for life, pay premiums for a specified period with coverage for life. That's it. So with a whole life limited pay or limited pay whole life, the policyholder only has to make payments for a certain amount of time on their whole life policy. And after that time, the policy is fully paid up and they no longer have to make payments. Sometimes it might be like they pay the policy until age 65, or they're going to pay on it for 20 years or something like that. Which policy loan provision allows for automatic payment of overdue premiums from cash value? Is it the loan repayment provision? Nope. It's the automatic premium loan. So the automatic premium loan will take money out of the cash value to cover a premium if it's overdue. That way the policy does not lapse. Okay, which of these is typically excluded from life insurance policies? Death due to illness, death resulting from criminal activity, death from a plane crash while a passenger, death from an accidental fall. Typically, it's death resulting from criminal activity. You can't go do bad things and die and then have the company pay the claim. Who typically completes Part 3 of the insurance application known as the agent's report? That's pretty obvious, self-explanatory. It would be the agent completes the agent's report. The agent's report is when you're selling a life insurance policy, you put any notes in there that the insurance company may want to know that could affect underwriting. What is the main purpose of the Medical Information Bureau in life insurance underwriting? It is not to provide medical examinations or verify credit history. The purpose is to collect and share medical information to prevent fraud. That way, insurance applicants aren't lying to one company and then getting away with it to another company. So say they apply with one company and they get declined for having cancer. They can't, that information is going to go in the Medical Information Bureau so that they can't go apply for another company and lie about having cancer. Okay, what type of insurance policy is best suited for covering funeral expenses with weekly premiums and a small face amount? Ordinary life, whole life, industrial. Well, this is a confusing question. Really, it is whole life, and it could be ordinary life as well. But it's industrial life. That's an obsolete type of insurance. People don't really sell this month, but it is. They do talk about it in courses and on some exams. So keep in mind, the premiums are collected weekly, and it's very small face amounts for industrial life insurance. Okay. Which policy feature allows a life insurance policyholder to assign ownership to another person? So assign ownership. So when you're assigning ownership to someone or something else, that's the assignment clause, okay? So that feature allows someone to transfer ownership of the policy to someone else, a person or a company. Okay. Blank term insurance renews each year without requiring new proof of insurability. Convertible has to do with changing a term policy to a whole life. Level term insurance will be level for a certain period of time and will not renew each year. It renews after a set period of time. That would be annual renewable term insurance. So every year an annual renewable term policy renews and the price goes up based on the new age. Blank insurance policies are issued under a single master contract for a group of individuals. That would be group life. So under group life, there's a master contract. Remember that. And each person gets a certificate of insurance. Okay. The blank provision allows the policyholder to reinstate a lapsed policy if certain conditions are met. That would be the reinstatement provision, okay? So I know some of these answers are in the questions, but the reinstatement provision, typically what someone has to do is they have to pay any back due premiums and then prove evidence of insurability. All right, Alex misses a premium payment and the insurance company covers it from borrowing his policy's cash value. Which provision allows this? It is not the reinstatement provision or the extended term option. It's the automatic premium loan provision. Okay, automatic premium loan, we covered this before, has to do with taking cash value to cover a missed premium. Okay, David's policy pays out double the face amount if he dies in an accident. Which rider does his policy include? Cost of living rider, we talked about this, how it increases the face amount if the person dies of result of an accident, increase the death benefit. Waiver of premium rider will pay his premiums if he is disabled. The correct answer is the accidental death benefit rider. Cost of living rider will increase the death benefit over time as inflation increases. So it's usually like 3% per year that a cost of living rider will increase the face amount of the policy. That's to make sure that over time, the death benefit has the same value as it did when the person first took out the policy, because money loses value over time. But the correct answer for this question would be C, the accidental death benefit rider. Next, Tom decides to buy a life insurance policy that combines fixed premiums with the ability to choose how the cash value is invested. Which type of policy is this? That would be variable life. So fixed premiums, variable life has fixed premiums, and you can choose how the cash value is invested. Adjustable life and universal life have flexible premiums. Regular whole life has a fixed premium, but you can't choose how the cash value is invested. In variable life, you can choose for the cash value to be invested in securities like stocks and bonds. Okay, next, Jennifer buys a policy where the premiums are lower for the first 5 years and then increase and remain level. What type of policy does Jennifer have? The answer is modified whole life. In a modified whole life, the premiums are cheaper initially and then increase after a specified period. All right. Limited pay is when the you only pay for a certain amount of time. And graded whole life, there's a couple different definitions for graded whole life. We won't get into that right here. And straight life is just when it's the same premium the whole time. Okay, if Taylor decides to terminate his whole life insurance policy, he can choose to receive its cash value. This option is known as the reduced paid up option. Nope, the reduced paid up option is when the cash value is used to buy a whole life policy with a smaller face amount that he never has to make a payment on again. The option, this would be cash surrender option, because in the cash surrender option, you receive the whole cash value. You surrender the cash to yourself. The extended term option is when the cash value is used to buy a term policy equal to the face amount of the whole life, and the length of the term depends on how much time that cash value would purchase for that face amount of policy. Then policy loan option has to do with loans against the cash value. Which of the following would qualify as a special class applicant? Okay, would it be someone in excellent health, someone with a low-risk occupation, someone with diabetes who pays higher premiums and has exclusions? That would be it. Special class applicant is someone who has high risk, so there's certain exclusions to their policy. And then the last one here, which of the following is a required component for a life insurance policy to be effective? Completion of a medical exam. Not every life insurance policy needs a medical exam. Not every life insurance policy needs an initial premium. Every life insurance policy does need an initial premium. That's the right answer. You don't always have to select your dividend options right away. And primary beneficiary, you can leave it to an estate. Like, you don't have to always have a set primary beneficiary, meaning you can always switch it. Okay, so we'll this here permanent primary beneficiary. So you don't have to have someone who's gonna get the benefit forever, because you can always switch that. Okay, so to buy a life insurance policy, you have to make your payment for it to be effective. Okay, cool. So I hope that helps you guys. If it did, all you have to do for a study guide is click the link in the description of the video, and you want to watch the next video coming up here, because I cover more questions and I go in depth on what can help you pass your exam. I hope that this helped you. Like I said, you can do this. You can make it happen. It all starts with the next video. Thank you.